Well, I think it's important maybe actually just for Friedberg to just explain what's happening. But
okay,
maybe let me just do the lead in and then Friedberg can do the details. But for those that are far away and aren't even sure what's going on, the basic problem that we have right now is in the last 36 hours, a key part of the financial plumbing of Silicon Valley has basically been turned off. And as a result, billions of dollars of deposits have basically been frozen. It means that people can't pay their bills. It means that people can't access their deposits. It means that credit lines could be in default. It means that payroll can't be met. And so as a result, we have this potential contagion on our hands. But in order to understand it and unpack it, I think it's important to explain exactly how this came to pass. So let me just hand the ball to Friedberg and then we can talk about some of the implications, of which there are many. Can I give you guys my little version of all of this? I think there are 3 buckets, but before I go into the 3 buckets, I just want to say to all of the employees at these companies, I think we, the 4 of us, are so truly sorry for what's going on and what you guys are going through. And then to founders that are trying to navigate this, it must be unbelievably tough. There are a few founders in our portfolio. So, from all of us, just know that we're thinking of you guys and hopefully everybody ends up on the other side of this by Monday or Tuesday with not a lot of damage. So let's just put that out there as sort of like goodwill and kind of good juju in the world for the next.
This is going to be a really difficult weekend for people who are trying to navigate this. Yeah. I think it's well said. Yeah.
I think that this whole debacle, I guess, is maybe the best word. There's a little bit of blame that you can put at the feet of 3 different groups of actors, and I just want to get your guys' reaction to this. So group number 1, and Friedberg just mentioned this, is we, the 4 of us, have been talking for the last 18 months about the impact of rising rates. And, we talked a lot about, for example, like in our portfolio, my partners and I walked into every company and made them have at least enough money to get through mid-2025, right? I've said this a bunch of times. And so that was about having very difficult conversations about making sure that you were husbanding cash so that you had enough to weather any storm that came on the horizon. But it turns out that there was some group of VCs and companies that just didn't get that memo and just kept spending like nothing had changed. But when other VCs have stopped giving you money and you're continuing to spend like it was 2020, that's what caused this mismatch. And it was really the spark that lit the fuse. So I think it's a really sad commentary at some level about the lack of governance that we have inside of some of these companies, where folks are just not doing the job that they're supposed to at these board levels. I think people, and we've talked about this, have made venture too much of a popularity contest where they are, glad-handing and smiling and not doing the hard work of holding folks accountable. And so some handful of VCs and some handful of founders just didn't get this memo, and it made what could have been a slower train wreck faster unnecessarily. So I think that's worth talking about. Then I think if you look at what actually practically happened over the last year and a half at SVB, was that they were so desirous of profits that they basically had a duration mismatch. So what is that? Imagine you get a job and, somebody's like, hey, Friedberg, I'll pay you $100,000 monthly over some number of months, right? In normal pay every 2 weeks, or I'll pay you $200,000, but you only get paid once a year. Well, the problem with that second thing is you still have monthly bills that you have to make up for before you get paid. And so most people wouldn't take that job even if they paid you a lot more, because you have this durational mismatch. You have to pay rent every month. You have to pay bills on a monthly basis. You have credit card bills, all these things. And so you need to match the timing of your cash flows. And so I think somewhere along the way, the risk folks at SVB just made a really large miscalculation. They basically went and bought 10-year risk in order to pay back money that could be called on a daily or weekly basis. That, obviously in hindsight, was not a good idea.
But more importantly, Chamath, they didn't adjust fast enough.
Well, they can't because they have these mark-to-market assets that were just getting clobbered in the head as rates got raised. And then the third thing is around regulators. After the great financial crisis, we went through a period where there was hundreds of bank failures. And then for the last decade, they've been virtually none, right? They've been like a few here or there. And the last one was just during COVID. And so the regulators, I think, have done a really good job with Dodd-Frank and all of these other things to clean up the banking laws and the reporting requirements and the capital structures so that runs on banks are more and more infrequent. But they kept this crazy loophole around the accounting treatment of assets, and they allow these durational mismatches to appear in a bank's balance sheet. And so I think there's a piece here for the regulators, which is here's an opportunity that's glaring and obvious now and screaming about how we need to tighten some more of the transparency that's required. It shouldn't be a group of armchair sleuths on Seeking Alpha that sniffed this out 3 months before it happened. It should have actually been a regulator that said, hey, hold on a second, something is happening here that we don't like. And so we, I think, need to figure it out. But I think those are the three actors that are in play, and they each share a bit of the blame here.
There's two things going on here. Okay, Freeberg, when I see your chart and you talk about laddering this and laddering that and X% and all this kind of stuff, I think about the smartest guys in the room. Okay, this is long-term capital management. This is Enron. This is the 2008 bank failure. They think they can basically do financial engineering to make this work. You know why it doesn't work? It's because number one, they're not in fully liquid assets. Number two, they're not marking to market every day. If you're a deposit bank, you should be required to keep all of your assets in fully liquid securities that you mark to market every day. It's that simple. And what do? They put it in 10-year duration mortgage
we need
bonds.
to explain this.
Hold on, where the value got devastated with the rise in interest rates. They didn't have to mark that to market. And second, they put 10% of the portfolio in basically loans to creditless startups. So when there is a run on the bank, you have a roughly 30% gap between deposits and the value of their portfolio.
Yeah. And listen,
that shouldn't be allowed. And the reason it's allowed is, frankly, I think regulators are completely asleep at the wheel. Where's Powell? Where's Yellen? 2 days ago, Powell was testifying in front of the banking committee, and they asked him, do you see any systemic risk in the banking system because of the rapid rise in interest rates? He said, no systemic risk.
Sachs is right. I agree. Hold on. Wait. Go ahead, Chamath.
Now, why in that meeting did they have to decide to emergency sell? It's because VCs stopped giving startups money. So startups couldn't deposit more money into the bank, but they kept spending at the same rate that they were spending.
In other words, means that the deposits went down. Yeah.
In the last 18 months, not enough folks read the memo.
Mm-hmm. Yes.
And by the way, the tragedy of that is, let's just say that you did get the memo and you did make the hard cuts. Right now, and let's say you're working on something and you can fill in the blank on the thing that you care about. Okay, so for the listeners, let's say it's climate change. Let's say it's breast cancer research, whatever it is. This had nothing to do with you 4 days ago. You had your money in the bank. You did everything you needed to do to go and, figure out product market fit, try to get to market, try to sell your product. And all of a sudden, because of some other set of folks and actors who couldn't get their act together, now you're on the precipice of bankruptcy in 36, 48 hours. That's crazy to me. Well, you have two paths here. Path number one is if you actually try to sell these assets. But the problem is, who do you think the buyer is? The buyer are the sharpest sharps on Wall Street who will purposefully underbid these assets. And so that then takes you to path two, which is then the only other real solution is for the Fed to warehouse them and guarantee them. And that's an equivalent version of what they had to do during the Great Financial Crisis, which was this thing called TARP, which is the Troubled Asset Relief Plan. It was just a backstop and a mechanism so that these, at the time, those toxic assets, which were a bunch of mortgage-backed loans, could be cleared through the system over time, which effectively meant that the Fed basically warehoused that risk. So I think what we need to see now is Sachs, it could be 50 cents on the dollar. It could be 60 cents if you want immediate liquidity. A friend in our group chat was mentioning that there was one claim a company that had $100 million inside of SVB was offered 60 cents on the dollar today for that claim. Now, that's from a third party who said,
Wow.
I will give you 60 million today in return for that certificate plus the 250,000 that says you're owed 100 million, because they're willing to take the risk that they'll get, 80 million,
Wow.
right? And then they take the difference. Now, the point is that if you're seeing today that kind of a discount, that's not a good sign, I think. And it does speak to the fact that regulators have to step in. Now, here's the other reason why I think it's important. I think what regulators, and I think the people, and there's a lot of them in Washington that listen to this, what this does is it torches years of U.S. innovation. And you should not let that happen. There are companies working on really important things for the United States and for the rest of the world. And if the company fails because they can't make the product work, so be it. We take that risk every day. If the company fails because customers don't want to buy it, so be it. If the product fails because a better product comes out, so be it. But it shouldn't fail because we can't get money that is
you forgot your pay
deposit. That should not be why we torch hundreds of startups and what they're working on. Maybe thousands.
Yeah, this would be a lost decade for Silicon Valley.